And that's what you have to learn, is if you can learn how to get attention by giving people value, then you create an annuity of attention, and anything that you want and find value in, you can already have a built-in fan base and audience to monetize.
All right, guys, welcome to another episode of Report. Today, I got a special guest. I got someone who's a serial entrepreneur. I got someone who invests in real estate. He invests in crypto and in stocks. I got my guy, my man, Brian Decker. Brian, welcome to the show, brother.
Thanks, Rich. Appreciate you having me on, brother.
Yeah, man. Appreciate you coming all the way out, man. You just mentioned you were hanging out with Tarek Musa this morning out in Newport Beach.
Yep.
What's Tarek up to these days,
Dude,
man?
filming like a crazy person. I think that's what a lot of people don't realize is, you know, when you go to look and you see they do an episode, right? They don't realize that that episode is like 11 days of filming of like 12 hours a day.
For one 45-minute episode.
One 45-minute episode, you know, and then it's not scripted at all, right? So when they're going through and doing it, you know, he'll do a scene and then all of a sudden somebody in the back in the crew will like trip over something and ruin the scene and have to go over and do the same thing over and over again. But you know, it's a lot of work, man. I'll give that dude credit. He's one of my best boys. And, you know, he's one of those people that I met that actually legitimately knows real estate and actually works his face off, which is, it's nice to see because I know we all see so many people on real estate TV shows and they don't really know real estate. It's for that. But, you know, I could say him and Heather are actually like world-class people.
Yeah, I can imagine. I've only met Tarek once. I went up to his place. He was on episode 2 of this podcast. We ripped it there in his living room, got to meet Heather, but I can attest to that. He was like, literally right after the pod, he's like, he got a driver outside. He's like, bro, I got a fucking 13-hour day of filming ahead of me.
Yeah.
And I was like, man, I don't know how you do it. You know, Pace has done the TV show thing on E&E, and he's like, bro, he's like, don't ever fucking do a TV show. He's like, the time is fucking second to none. It is insane.
Oh, dude. And then two, we know in SoCal, I mean, he has to go back and forth between Orange County and LA. So you lose 2 hours each time, drive all the way up to LA.
So he's doing filming up in LA. It's not in like Santa Ana anymore.
So they do multiple locations. So it depends on wherever their show is. So they have their big show that they're filming right now for, which is called The Flip Off. That's like basically his ex-wife Christina and her, I guess now ex-husband, and then Tarek and Heather, and they basically, it's kind of for like the flipping king or queen of HGTV. So they each basically bought a house, they're flipping that house, they're filming those episodes, and whoever flips it for the most profit gets crowned the king or queen of HGTV. So he's doing that in addition to all the other shows. So
I heard his ex Christina broke up with her new husband.
Yeah,
is that true?
Yeah. You know, and I think it's one of those things too.
She likes to hop around a little bit,
apparently, right? And I think it's honestly like when him and I will travel and go places. I could never deal with it. The amount of people that constantly, like him and I were sitting on a flight. We were flying out to a keynote that we had in Detroit, and we're sitting in first class, just sitting there. At least 6 people, full phones, full video in his face, just filming 2 inches away from his face as they're walking by him. And of course, like your reaction would be, at least mine, be like, what the hell are you doing? Get away from, but you can't because then it ends up on TMZ. So I think just that constant, no privacy, people in your face, I think it'd be, I mean, I've been married 10 years, been with my wife for 12, and marriage is hard enough, let alone when you're in the public eye, people constantly stirring things up. So I think it's probably pretty hard to maintain a relationship like that.
Dude, I can imagine, man. But at the same token, it's like if that's the price you got to pay to live the fucking life that you want to live and to have the financial freedom and to be able to inspire a lot of people, I think for me at least, I would take that trade-off 365 days out of the year. But not everyone's like that.
Yeah.
I would be down to take that trade-off though.
Yeah. And I think for me too, I mean, and I think it's where a lot of people don't realize that they don't realize the trade-off for sacrifice. I mean, I got 2 kids. I got a wife. I'm flying constantly. I'm having to maintain my time management, having to come home and put the dad switch on from being in the entrepreneurial switch. But that grind, if you have to learn how to like compartmentalize it, right? And I think if you've learned to like let things roll off your back, and you know, as an entrepreneur, I mean, you know, you got to get rhino skin. You can't carry a bad call into the next bad call or whatever it is. And so I think you just train yourself to do it.
Yeah, dude, you got to learn to get numb to all the different situations. Like, I mean, you know the game better than me, but it's like you're putting out so many fucking fires, and I might jump into a fucking meeting, find out some fucking crazy news, like one of our hotels is getting flooded out, and then I'm jumping into a podcast guest is downstairs, I'm jumping to another meeting. So it's like you got to learn to like fucking really put your emotions in check and just be numb to everything. But one thing I learned is like, you know, over the years, I learned that like things are never as good as they seem, and things are never as bad as they seem. We always fucking figure it out. You know?
Yeah. I think one of the best quotes. So one of my mentors, this guy named Matt Ishbia, he's the owner of the Phoenix Suns, and he said, I was sitting down with him, and he's at dinner one time, and I was like, Matt, okay, you own the largest mortgage company in the country. You're bigger than Quicken Loans. You got 9,000 employees, and now you run an NBA team on top of it. Like, first off, those are two completely different industries. One, you're dealing with a bunch of prima donnas, which are athletes, and on the other side, you're dealing with massive realtors and loan officers, which this deal, they act like every deal is like the biggest thing that ever could happen in all of these. How do you handle it? And he goes, bro, I have amnesia. You just got to forget about it, man. He goes, you have to have amnesia. You cannot, like, when something happens, you just got to be like, hey, you know what? I'm going to delegate it. I'm just going to forget any of the emotions, and I'm going to go into the next one. Otherwise, I'm going to create 7 more fires because I'm not paying attention to what I'm currently being present in. So he's like, dude, anybody in sales, anybody as an entrepreneur, you just have to have amnesia to the bad shit.
That's so good, dude. I love that. So we got a lot of talk going on with the Federal Reserve and the interest rate environment. Are they going to start cutting rates at this next Fed meeting here in September? There's a lot of speculation out there, so we'll see what happens. But what's your take on the market right now and how it pertains specifically to the interest rate environment?
Yeah, so here's one of the things I think. First off, I think Fed's going to cut rates, and they're going to cut aggressively.
Really? You think aggressively?
Oh, yeah. And here's why what most people don't realize. So we all know, like, everybody that was ever in real estate or in the stock market, everyone's like, oh, 10 years of boom, then we get a bad bust, and we go through the cycles, right? We all know those cycles. You have your expansion period, and then you have your blow off top peak period, and then you have a recession, then you have like the doldrums of a depression, and it repeats itself. Well, that's the way that the economy in the United States always worked from pretty much 1900 to 2008. But one thing that actually changed in 2008 that people aren't really accustomed to is the amount of debt the United States obviously got in, right? So the best way I can explain it to somebody is, say you're a household, and let's say in 2008, you were $5,000 into credit card debt as a household, right? Well, you don't have a job, you lose your job, you do this. Well, you got a little bit of bandwidth because you got some extra limit on your credit cards, right? And so you can survive a little bit on your emergency savings. Now fast forward that, and let's say now you're $300,000 into credit card debt this recessionary period. Well, guess what? The slightest little change in interest rate, I mean, you're ruined at that point, right? Well, that's the federal government, right? So the federal government, it took us, 220 years to get like $1 trillion into debt. Now we're $35 trillion into debt. Well, the thing about our debt is when we issue our debt, we usually issue it either in a 3-month payment, a 2-year period payment, or 5 years. So based on our treasury bills, right? So when we issue that debt, so if I go, hey, Rich, I'm going to issue debt, and Rich are like, yeah, okay, I'll buy your debt, Brian. And I'm like, okay, how about as a 2-year term sound to you? And you're like, yeah, that sounds good. Okay, whatever the treasury bill rate is on that 2 years of the time we sign it, it gets locked into that. Well, at the end of those 2 years, just like any balloon payment, at the end of those 2 years, I have 1 of 2 options. One, I can completely pay off that debt from money in my savings account, or I got to refinance that debt. Well, the federal government doesn't have the money in our savings account to pay off all this debt, so they have to refinance this debt. So you can imagine 5 years ago when they were borrowing at 1% interest rates. 2 years ago when they were borrowing at 1 to 2% interest rates. Well, today, that debt that's being refinanced that they originally borrowed at 1% or 2% is now 4% or 5%.
Yeah. And real quick, for the listeners out there, the Federal Reserve has printed 80% of the money supply since the year 2020. So this is the last 4 years. Hey, think about that. The money supply has essentially almost doubled in the last 4 years. Now, the reason why we're not seeing all this asset appreciation and rent growth and inflation right now is because a lot of that money is off the table in long-term government bonds because of the rate environment. Now, that rate environment is temporary. When it goes back down, get ready.
Exactly. And you nailed it. And so every investor, what they need to follow, interest rates are important, but the leading indicator is M2 money supply, right? So M2 money supply is basically the free capital in the market that people have availability to invest. So for an example,
it's like liquidity.
It's liquidity in the market, right? Okay. So think about it this way. It's if you're an average household, how much money do you have available on your home equity lines of credit, and in your bank account, what can you borrow against your stocks? That's called your M2 money supply. Well, what happens is the federal government has kept interest rates for far too long because they needed to fight inflation. Now, the Fed has what's called a dual mandate, right? Which basically means everything that they do, it's like the Fed's 2 core values, right? Number one that they have to do is keep inflation down so that the cost of living doesn't get out of control. But more importantly, the first Fed mandate is maximum employment, okay? Their job is maximum employment. So everybody right now, they've been fighting and saying, hey, we got to keep inflation down. Well, guess what? Jobs growth is still okay. It's still doing this. Well, what we just had today, August 21st, when this is being filmed, the Fed just released a revised jobs report, right? So every year in April, they release the job growth number for the entire year. So in April of this year, they released from March of 2023 to the end of March of 2024, we created X number of jobs. And it was 2.9 million jobs what the United States created. Everyone's like, see, we can keep rates higher because the Fed. Well, they revised it down today by not just a little error. They were like, oh, sorry, we screwed up. We magically counted 880,000 full-time jobs too much. So that hit the markets today.
And what was the reason for that 880,000 jobs?
Here's the real reason. So a mistake like that, the way it works is the federal government, they know that they have all this debt, $13 trillion worth of debt that has to be refinanced and is reaching at maturity. Majority of that is coming in Q4 of this year, Q1 of next year, and Q2 of next year. There's like $9 trillion. Well, guess what? We don't have the money to pay a higher interest expense on that debt, right? It's at 1 to 2% debt. Well, if we refinance that now at today's rates, you're 4%. That means our interest expense doubles, which means we have to print even more money just to pay the interest on the money we can't pay back, right? So what happens is they look at that and they say, well, we can keep raising rates or keeping rates stable as long as we have a strong economy. So I guarantee you what actually happens is they're like, let's estimate the job numbers. We're going to estimate it. Let's go on the high side so everything looks okay for this current economy. We're going to tell everybody a soft landing is going to be happening. Then as we get closer to the election, what they do is they're like, okay, well, we got inflation to 2.9% last month. Well, it's not 2%, but it starts with a 2.
Yeah.
Okay, now we can come out with the revised jobs report number that says, oh crap, our economy's not doing good. That's why consumers are in credit card debt. Everybody who's a realist knows like the job market ain't that good right now. Like we all knew that, right? And so now it gives them the full capacity to start slamming down rates, turn on the money printer, start giving away free money, aka candy, right ahead of an election season, which to your exact point, when you turn on the money printer, M2 money supply goes up, real estate, stocks, crypto, rent, everything is a repeat of what happened in 2021. And the year following an election year is basically run that money printer, make everybody happy for whoever goes into office on that first year. And then what happens? Inflation ticks back up. They have to raise interest rates again. And it's just a repeat cycle over and over again.
Yeah. So it'll be interesting to see what happens. Now, you're thinking, so the next Fed meeting is September. Mm-hmm. Are you thinking a quarter point or a 50 basis point?
Here's the thing is, after today's jobs report, I would be inclined to think it would be a 50 basis point cut, believe it or not. Now, depends on who's, and this is, and I'm not going to make this a political podcast by any means, but here's the thing is, at the end of the day.
We can talk all the politics you want.
Perfect, good. Yeah. All right, so here's the rule. If Kamala is down in the polls, it's going to be a 50 basis point cut. And here's why. So number one is we know that Janet Yellen, who is the head of the Treasury, who gets to actually be the one that prints all the checks. She is Biden administration full bore. Okay. Jerome Powell technically has to be a separate entity, but whatever Jerome Powell really wants to do, he gets told what to do by Janet Yellen. Janet Yellen is the most powerful woman in the world. She's the one that controls how much money gets put out in the economy, how much debt they put out there. Everything runs through the Treasury. So if Kamala is down in the polls, what they are going to do, mark my words, is they will do a 50 basis point cut. Second that happens, the stock market anticipates a 25. everybody and how good they feel about themselves, their biggest two assets are their 401k and their house. So when you do a 50 basis point cut, interest rates come down, home values tick up, stock market goes up. Everyone's like, oh my gosh, guess what? The Democrats in office, wow, they're really turning this thing around right before the election. Pull Kamala back up in the polls. That's
and inflation lags, right? So the inflation will still be in the twos, and interest rates go down. The sentiment, the bad news in the marketplace is now good news.
Yep.
Okay, so I could see that. So if they go 50 basis points with the cut in September, will they follow up with another 50 banger in October?
No, what they will do is, I think that they'll technically pause in October, and then what they'll do is, depending on who wins, the following meeting after that will be, if let's say Kamala wins, the following meeting after that, they'll probably hold up and maybe just do a 25 basis point cut. If Trump gets into office, they'll slam another 50.
Now, let me ask you a question, because I talk about this all the time. If you would have told us, anyone that has any knowledge on investing and money and how the money supply works, real estate investors, et cetera, 30 months ago, 2.5 years ago, it was the beginning of 2022. That's when the rate hikes started happening. If you'd have told anyone back then, the rates were more than double for 30 consecutive months, and we wouldn't see a complete crash in the real estate market in most markets around the country, I would have thought you were crazy. Would you have thought the same thing?
You know what? If you actually go back and look at my content that I made on my social, I was actually saying that we're going to get what I call a bifurcated real estate market.
What does that mean?
So what it means is this. People make the general assumption of real estate that all markets participate the exact same way. But there's one variable in real estate that I've been able to kind of put my finger on that is the difference between a real estate market like San Diego that's crushing it right now and a real estate market like in Florida or Tennessee. I don't know if people have been paying attention to what's been happening in Florida and Tennessee. Home prices are dropping. The difference is new construction. You cannot control inventory in a market that doesn't have a lot of land to build. Why is San Diego prices keep going up 10, 15% per year? Everybody's like, dude, you need to make $300,000 a year to buy a normal single family house in San Diego. And people are like, nobody's going to be able to afford that. Well, guess what? They do, right? And the reason why is they don't have another option. People have two options: rent and spend $7,000 a month in rent, or suck it up and buy a house in San Diego, or get the F out of San Diego and go move to somewhere where it's really cheap.
Well, unlike Tennessee or Florida, in San Diego, you got a lot of bureaucracy, you got a lot of red tape, which poses a lot of barriers to entry for builders to come in and build. But secondly, San Diego is also an island. So from a supply standpoint, you got to the north, you got Camp Pendleton. To the west, you got the Pacific Ocean. To the south, you got the Mexican border. To the east, you got the mountain ranges. So from a supply standpoint, there's not a land to
You're landlocked.
Yes, there's not a lot of land to build on. And so as more and more people move here for the weather, yes, there's people leaving, but the people that are leaving are low income, you could argue. And the vast majority of the people coming in have higher income, which is driving the prices up.
100%, you nailed it. And all you have to do to look at a real estate market and to decide if interest rates are truly going to really affect that market is look at, will supply come into the marketplace? So right now we all know all these people are sitting on 2, 3, 4% interest rates. So people that have money and they want to, let's say, sell and they want to move somewhere else and they got a 3% interest rate, they're renting that thing out. They ain't just being like, hey, let me go put this on the market. They're renting it out when you deal with high income. Number two is you don't have another option when you move here. It's not like you can be like, oh, let me go look at the 72 different housing developments that they're building. You got no choice. California is the shortest supply of new construction of any major area anywhere in the country. And so what happens is when we all went through it with COVID, we all remember what planes and boats and exotic cars did when we got all this liquidity. There wasn't enough supply because all the car manufacturers couldn't get those stupid chips. So what happens? You were able to sell your car that was a year old for 50% more than you paid for it.
Which is crazy.
Which is nuts.
Yeah.
And so that's what you saw. And so if you go in and you look at, so I was doing a keynote on this whole thing today, so it's kind of fresh in my mind. But if you look at a place like Tampa, Florida, okay, Tampa, Florida, massive amount of new construction in Tampa, Florida. Tampa, Florida, and you look at all the markets that are being the weakest right now. I live in Scottsdale. Scottsdale itself is landlocked. It's a small area that you have, and you got Paradise Valley and Scottsdale. Around that, you got giant Phoenix Metro with tons of land available with lots of new construction. Scottsdale, in my zip code, prices are up 16% in a year with an average house price of $2.5 million.
And if you go back to 2015, the appreciation in Scottsdale is fucking crazy.
Yes, it's nuts. But you go to Phoenix and you go 4 zip codes and 20 minutes away, house prices are dropping. They're down about 8% year over year. Why? There's a crap ton of new construction. And the difference with new construction is all these builders went in, they all bought tons of land and started building with a major lag time in all the markets that got massive population growth after the pandemic. So any market you look at that had massive pandemic like inflows to it, so your Idahos, your Floridas, your Texas, your Tennessee, your Phoenix market, basically any of those red states that everyone kind of fled during the lockdown, and they have new construction, those markets are getting the crap kicked out of them, whereas the markets that are landlocked and have low new construction, they're doing, it's a bifurcated market.
Yeah. So would you say there's not a lot of land to build on in Scottsdale right now?
So not in the city of Scottsdale,
Gotcha.
no.
Gotcha.
Yeah, so it'd be like, the way you can best think of it is like in Carlsbad, you go Carlsbad Oceanside, right? They're, 1,000 feet from one another, but what's the difference of a price of a home in Carlsbad versus Oceanside?
50% at least.
Right?
Yeah.
Why? Because people don't want to say they live in Oside, right? They want to live in Carlsbad. In Scottsdale, the city itself is like a Beverly Hills of Arizona.
Yep.
Right? You go, and even if they call it whatever they want to call the town, oh, this is Arcadia, or oh, this is this.
Paradise Valley.
Yeah. You got a Phoenix City address. So the big difference is when people come in, like when we were looking to buy houses, and I'm not the guy that like wants to flash, but guess what? I'm like, I want to say I live in Scottsdale because it's got better school districts, it's got better government, it's got better everything in it. So I want to be in Scottsdale. So Scottsdale isn't that big of an area, whereas Phoenix is a 5.5 million population. And so in Scottsdale itself, there are no new construction developments. There's only developers building, 5 or 6 houses, and that's it.
And if you go into Scottsdale, so like my luxury property is in what they call the magic zip code, 85254. And the reason they call it the magic zip code is because you're on the Phoenix side, but you have a Scottsdale mailing address. You get the Paradise Valley School District where all the schools are 9s and 10s. And you can get the real estate there for probably 30% less than you can in the city of Scottsdale. And I think from an Airbnb perspective, I feel like the Phoenix side is going to be slower to regulate versus the Scottsdale side.
100%. And you nailed it. And the one thing that most people don't know about, like even in Scottsdale itself, and why you're also seeing new construction get beat up even in the Phoenix area. So let's say I'm a home developer and I go in and I buy and I build a bunch of houses on vacant land, okay? When I go to sell those houses, the taxes, the property taxes on that house are based on the sales price of that property because it's a brand new property tax from vacant land to that. The house that we bought was actually, somebody bought an older home, blew it down, built, $5 million house on it, but my property taxes were based on, and they do not change. So my property taxes on and this is not like a flex, I'm just illustrating the point. On a $5 million,
on a little bit.
On a $5 million house, my property taxes are $6,000 a year.
Damn.
And they only can go up 1% a year. So when I am coming in and I'm looking at that as an affordability standpoint, and I want to go buy a $700,000 new construction home, my property taxes are more than my $5 million house.
And which side are you on? You're on the Scottsdale side?
I'm 852. I'm 85260.
Okay.
So I'm right on Scottsdale and Shea.
Yeah.
Like I'm to one street over is Paradise Valley. And then I'm right in that, let's call it Cactus Quarter area.
Yeah. And I think the other bonus to the 85254 zip code that I did not mention is you get the Phoenix property taxes, which is slightly lower. But that's cool, man. Love the market, high growth market. For me, man, I'm all about going into high growth markets. When I first got in the real estate investing game, I was like, I want cash flow. I want to some of these Midwest markets like Cincinnati.
Yeah.
And now I'm like, that doesn't get me out of bed anymore. I want the high growth stuff like Scottsdale, like San Diego, the areas where I'm going to make a lot of return over the long haul. I want to let inflation do its thing. I want to buy in the good locations because that's the name of the game. Real estate's about debt and taxes. So speaking of debt and taxes, we talked about the debt side. Taxes. What's your thought on the taxes right now? There's a lot of talk in the political climate based on who gets elected, where the taxes are going to go. They're talking about taxing unrealized gains. 25%, maybe even a little bit more. That's some freaking crazy talk. What are your thoughts there?
Yeah. So one of the things is I think it's absolute insanity to be able to do it. The only good thing I'll tell everybody is let's say Kamala gets in office and let's say she tries to put forward her policy. Now, this is 100% a political stunt. There is 0% chance that this gets passed for two reasons. So first off, number one, Kamala gets in office and she says, hey, I want to do, her whole thing is let's tax the super rich so we don't have to tax the middle class, right? Here's the problem. Even if she gets in office, her own party in the Senate, and the House, you are literally looking at she has over 50, almost 60% of Democrats in her party opposing the unrealized gains on capital, or unrealized income on capital gains, yep. Right? So, and then every Republican votes no for it. So the chances of it passing are 0 to none, because I think you even made a post on it. Well, if we tax unrealized gains, do we get money back for unrealized losses, yes. Right? And so the whole thing about this, and the reason why this is stemming from it, it's like my entire retirement strategy that I'm basing it on is that I can literally make enough money and won't have to pay taxes really ever again. And it's the same thing that Jeff Bezos or Elon Musk or any of these guys do it. And my plan is to do it obviously on stocks and Bitcoin. And the reason is it's very simple. So how Elon Musk and Mark Zuckerberg obviously live, they got, $100 billion in their stock, right? They don't ever want to sell that stock because their cost basis is nothing. The capital gains tax, even on a long term, would be insanity. So what do? They keep their stock. They go to a bank. They get a massive line of credit. They live off that line of credit. You don't ever pay any income taxes on borrowing debt. Just like if you have a bunch of free and clear properties, don't sell them. Go take home equity lines of credit on them and live off of it, right? And so what they're trying to do is to close that loophole, is basically say, hey, it's really unfair that these super rich people figured out a tax loophole that they never are going to have to pay taxes on their giant, massive net worth by never selling it, therefore never realizing the gains. They just borrow against it. But if they do that, they're going to be chasing their tails, because now every big real estate developer, they're doing the same thing by taking out lines of credit or mortgages. So they're never going to fix that problem. How somebody thinks it's unfair, it's not unfair. Acquire assets, live below your means, have somebody else pay off your asset, the debt on your asset. And then when you get to retirement, borrow debt against it, live on your debt. And guess what? You're never going to pay capital gains on it.
Yeah, and they don't teach that in school. They don't. They teach you, to not take out debt, play it safe. And Grant Cardone was on the podcast, and one of the things he said, if you don't learn, he said, if you want to stay in the middle class, don't use debt. If you want to go to the top, learn to use debt.
Yeah, it's so true. And I think the big thing that people realize is when they think of debt, I think Dave Ramsey has scared every human being on the planet that debt is bad. Debt at a high loan to value is bad. But there is nothing wrong. Let's say somebody has, 20, like I have a bunch of money in crypto, right? I'm just going to throw a random number out. Let's just say it's $10 million. If I borrow a $2 million against that as a line of credit, the chances of me ever on Bitcoin as an asset or real estate, I'm never going to be underwater if I keep my loan to value super low. So I can take that money rather than selling the asset that is continuing to go up at time and never run any risk at all. And say it's $2 million. Everyone's like, well, what about the payment? I just have $2 million in cash in my bank account. I can pay the stupid payment for the next 25 years. What are you worried about? And then as that asset goes up, I can just keep my loan to value at 20%, and my line limit just keeps increasing as that asset increases over the value of time.
Yeah. I love that. So speaking of crypto, what's the latest with the crypto market these days?
Yeah. So first off, I always like to tell people I was the biggest anti-crypto guy on planet Earth. And
before you got into it, like when you were doing the real estate stuff?
Yeah.
Okay.
And
how come?
I thought it was a Ponzi scheme. I really did. And like most people, my brother actually got into Bitcoin and got into crypto mining really early on, like 2011, 2012. And so it's probably 2016.
So you used to hate on your brother, be like, yo, dog,
all the
what
time.
are you doing?
All the time. I'm like, this is a Ponzi scheme, because nobody could really explain it. And back then, nobody was buying it. You didn't have hedge funds or pension funds and all the, all this. And so my brother finally convinced me to buy it. And I think I threw in like, I don't know, 50 grand or something. And of course, I threw it in when I heard my barber talking about it, heard everybody talking about it. I didn't know anything about the cycles of it. Threw 50 grand into it. And then I looked like 9 months later and it was like, I don't know, $7,000 or something. And then I sold it, pulled my money out and was like, screw this, right? Well, what ended up changing for me was I had an exit out of a company and I got some cash. And this was in 2019 at the time. And I really started looking at it and was like, okay, I don't want to put all this in real estate. I already have a bunch of money in real estate. I sure as hell don't want to just put it in a bunch of cash in the bank and get 1 to 2% at the time. And so I really started like going down the rabbit hole. And I was like, okay, well, let me look at gold. And I was like, gold's kind of been flatlined. So I kind of like looked at everything. And I started like really realizing it when some of the smartest people that I really study in the world, which is a guy named Raoul Pal. He's like the most successful trader at Goldman Sachs. And Raoul Pal, and then I started seeing Elon Musk, started seeing these guys get behind it. And I'm like, okay, I'm definitely not as smart as these dudes. These guys must see something. And then I realized, okay, Bitcoin itself, I'm just using that as an asset. You got 21 million coins that'll ever be in existence. And what ends up happening is in order to, basically issue coins into the market, it's pre-programmed, right? That basically says, okay, you work on the network. So basically, easy way to explain it is, if I wanted to build a network like that, is to change the payment system in the world. And I said, okay, how am I going to build this network? Like, I want these people to build it. Well, why don't I just say, hey, guys that code and build the network, all these coders basically there's a giant vending machine, and once every 10 minutes, a Bitcoin will drop down, and whoever's the guy that writes the last line of code in that 10 minutes gets that Bitcoin, right? And so what I've been able to do is I had all these guys build the most secure network, and I paid them in Bitcoin, and that Bitcoin had a finite supply, and the amount of money it took to solve these mathematical equations to build the network got more and more difficult, that it required more and more energy to use this. Therefore, the reward that they get is going to have to end up going up in value because of the work that they're doing, and the cost is going to go up over time. And when they then said, okay, well, there's only ever going to be 21 million of them, and we're going to issue 50, every 10 minutes. And then every 4 years, then it's going to be 25. It's going to go, and we're going to cut the amount of Bitcoin that we release.
What is that called?
It's called the halving.
Okay.
Right? And it happens once every about 4 years.
Okay.
Well, when that happens, somebody is doing more work that costs more money because it's more difficult, takes more electricity, more manpower, becomes more complex. So they got to use more complex computers to be able to do it. And then I'm only going to give them half the reward that they were getting to do it previously. And so I started looking at this, and I realized, I was like, this thing should have been dead by now. It had been around by this time, like 10 years, right? And at the time it was like, I don't know, $4,000 or something like that. And I was like, okay, this thing has made it through all these cycles, all these things but it just seems to keep going up. And so I started looking at it and really diving in, and I understood real estate. We all know with real estate, it's pretty simple. Interest rates go down, and you're in a market where there's not a lot of supply, and you have people that want this asset, prices go up. It doesn't matter. It's just simple form.
It's time tested.
Yep, it works, and over time. So I started looking at Bitcoin. I'm like, okay, well, if half the supply gets cut once every 4 years, it becomes more difficult to do it. This Bitcoin has had the adoption rate of twice that of the internet. It's the most adopted technology in human history. And at that time, I just started seeing pension funds and other funds start to acquire this asset. And so I ended up getting into it. I put about $1 million into it. And I was like, I'm going to take people on my journey with this on my social. Either I'm going to look like the world's biggest idiot, And I used to trade on, like, I was a technical trader. I traded stocks and did all that. Or I'm going to look like a genius. Either way, I don't care. At least I have the balls to do it, And so I took people on the journey from end of 2019. And then I sold out my portfolio in the middle of 2021 and turned $1 million into 7.7 million in front of like 200,000 followers on my social.
And you sold all your Bitcoin?
Sold it all out at 64,000.
Yeah.
And so I was like, okay, like I really understand this. And then Since then, what we started to see is now you have BlackRock. BlackRock owns the world. I mean, they have 10 trillion in assets under management, which is just nuts. And so we went from an environment that 4 years ago, you had Jamie Dimon, one of the most powerful people in the world, CEO of JP Morgan Chase, said he would fire any one of his traders that even owned Bitcoin. And now here you are, JP Morgan Chase 4 years ago is acquiring an insane amount of Bitcoin. Bitcoin's ETF, which is basically like we have gold ETFs, it's basically, a stock that you can buy. And for every dollar you spend, you actually control and own $1 Bitcoin. The Bitcoin ETF that was launched in January is the best performing ETF in the history of any ETFs. And you have BlackRock, who now in the last 6 months owns 3% of the entire Bitcoin in the world. They've bought in $40 billion of Bitcoin in 6 months. We have two political candidates that now have shifted their political regime to include crypto into their political environment. You now have these massive funds, like you have Goldman Sachs, who's buying $100 billion of Bitcoin a quarter. And we look at the amount, there's 21 million of them, and there's 60 million millionaires in the world. That means only 1 out of every 3 millionaires can even own a stinking Bitcoin ever.
Yeah.
It's just math, right?
I mean, the same with the real estate. I mean, when you see the institutional capital going into certain asset classes or going into certain markets and buying up the real estate, hey, there's a lot of attention going there and it's strategic, but same thing's happening with Bitcoin, which is crazy to think about. So as you look into the future, the last, what do you call it, a halving? The last halving was what year?
So the last halving just occurred in end of April of this year.
Mm-hmm. And what happened?
So basically the way it works, this is why I love it. So
what did it do to the pricing?
Here's the way it works. So just think of it this way. The best way to explain it is real estate. So when the Fed starts cutting interest rates, let's say the Fed cuts interest rates in September, real estate prices aren't going up 10% in a month, right? What happens is that real estate that interest rates have to start working its way through the market, right? And then what ends up happening is, let's say the Fed came out and they slashed interest rates by 1%, right? And let's say something crazy, some big number. And mortgage rates drop from 6.5% to 4.5%. Well, now what's going to happen is people are going to be like, okay, I'm going to get my house ready to sell it. I need to get pre-approved. I'm going to do this. It takes a lead time before it really starts affecting the market. Well, the same thing is true with the halving, and it works perfectly like this. And you can look it up on the charts. When you have a halving, between 150 and 170 days after the halving occurs, you start a parabolic run. And this is the fourth halving. This has happened with 100% accuracy in all 3 previous cycles. So my prediction is, starting with the Fed rate cut in September, beginning in October, we will start to see Bitcoin's price, which right now it's 61, 62,000 as time of this filming. Bitcoin's price will start its run. Bitcoin will go parabolic over the next 6 months after that. And from the date of the halving to 1 year after the halving, every single time, Bitcoin's price, I guarantee you from that point in time, will at least double. So
we're talking to 120,000.
Yep.
And because of that, will you be putting your money where your mouth is?
Oh, by 100%.
Okay.
I'll be very frank. If I looked at my liquidity right now, let's just say I have, let's say $8 to $10 million in liquidity. I got a $6.5 million crypto account. And but I'll take it to 15, 16 mil. But here's what you have to understand is, when you go into crypto, and people are like, well, what crypto? Okay, the best way to explain it is, when you look at the stock market, right? You got like the NASDAQ, right? If you invest in the NASDAQ, right, you're going to do well over time. It's consistent. That's Bitcoin. Bitcoin always goes up. It just does. You look at it a 4-year cycle, sure, it draws down, but anybody that bought Bitcoin 4 years ago is up significantly. Anybody that bought Bitcoin 8 years ago is up significantly. However, within that, you got a million cryptocurrencies. Most people make the mistake, they're not all trying to be money. So when you launch a company, and you know this, when you launch a company, you take a company public, you start a C Corp, right? You have a C Corp, you issue shares of your stock. People buy shares of your stock because they are betting on the growth of that company, and the price of it will go up. Well, the new way that companies are starting, rather than doing it as a C Corp and going the stock market route, is what they do is they start what's called a DAO. It's a different corporate structure. And rather than issuing stock under that corporate structure, you actually issue a token. So what people don't understand is not all those things are trying to be money. Very, very few of them are. What they're just choosing to do is rather than take their company through VC and raise capital that way, they look at it and they say, hey, I would rather start it as a DAO rather than issuing a stock. I'm going to issue you a token. And so by doing that, you have all these crypto companies, just like there's millions of penny stocks, but there's like 40 or 50 of them that are like, for example, Solana. Solana is processing right now in transactions on their network 3 times more transactions per month than Visa. And why? It's faster, it's cheaper, it's better to use. So Solana is a great project to buy, just like you're betting on a tech company. They just chose to issue a token rather than issuing a share of stock.
If you love real estate investing, passive income, and tax benefits, but don't have the time, my company, Summers Capital, is buying boutique hotels right now. We source the deals, we renovate the properties, and we even handle all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, visit summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show. So how about all these other like crypto companies, right? You got like Ethereum, Solana, you mentioned. There's dozens and dozens. Are they all backed by something real and with good fundamentals, or are a lot of these just kind of like blowing smoke and you should only invest in certain ones like Bitcoin?
Yep, 100. You nailed it. 99% of them are just blowing smoke. Just think of it this way: is you do well. How many decks do you get that come across of investment opportunities that come to you? Lots of them, right? Yeah. 9 out of 10 of those are going nowhere. They sell the dream. They raise money from people that don't have a good business sense. They end up flopping. The investors can choose to either one, they blow all their money trying to make their business.
You're talking about startups, right?
Startups, yeah, exactly, yeah. Right? Same thing. So what you want to look at is something like Ethereum. So for example, with Ethereum, what it basically did, and the best way to explain it is, we have the internet, right? We have the internet today. Well, the internet itself, HTTPS, the network, right? Nobody owns that network, right? Nobody owns it, right? All the companies that made money on the internet are a website or an application on the internet, right? Facebook, all these ones, they did it. The best way to explain it is, imagine if you could have bought stock in the actual internet, and that every time a company wanted to advertise on the internet, they had to pay the owner of the internet $1 per visitor, right? Well, we all know the problem with the internet is today, it's what Elon Musk trying to solve with Twitter is censorship, and they own your data, right? So Meta owns all of our data, takes that data, markets it to us, sells it to us, and makes tons of money. Well, what happens with Ethereum did was they said, hey, I don't like the fact that these big companies own all of our data. They basically don't pay us for it all. We're going to create a competitor to the internet, and that is going to be called Ethereum. And here's the way it's going to work. Nobody's going to own that internet. It's completely censor-free, decentralized, and anybody that wants to use Ethereum, the new internet, basically what they have to do is, if I want to launch a website or launch a company that uses this, they have to pay what in Ethereum, or like an internet coin, they have to pay, and it generates these fees. And just like if you could own a stock and a share of the internet, that's going to go up. Well, Solana and Ethereum are both solving that problem, just in different ways. Ethereum's focusing on the world of finance, having people. Solana's focusing on the world of speed and transactions. So when you do that, when you want to look at investing in those things, buying a Solana coin or Ethereum coin, all of the profits that these networks are making, which are hundreds of millions of dollars a month, because think about it, if you're going to start a company nowadays, you kind of are worried about being like, hey, you know what, man, what am I going to do with all this data? I'm sorry, as a consumer, you're like, man, I go on Facebook, they're following me around, they're hearing what I'm having to say. We're finally starting to wake up to the whole problem of we don't like that we're censored with everything. So these are those alternatives. So you want to look at companies that have good fundamentals like that, and that's what you want to invest in, which, let's be real, it's probably 99 out of 100 are garbage. And that's why people are like, well, I bought Shiba Inu. Well, bro, it's It's a fucking meme, dude.
Yeah.
It doesn't have any utility. But go buy a stupid penny stock and see if you make money.
Straight gambling.
Straight gambling.
Yeah. So I'm curious, with you having a high baseline knowledge in real estate investing, different asset classes within real estate, crypto, stocks, for someone maybe listening to this right now and they're like, you know what, I got some extra liquidity. Do you suggest someone picks one and kind of goes all in, or do you suggest someone kind of diversify across these different asset classes and investment vehicles?
Yeah. So first off, I think everyone needs to divide the way that they think into two different buckets. You have your long-term bucket that is like, this is stuff I'm going to put things in that I'm not going to pay attention to what it does on a weekly or daily or even annual basis. This is my, hey, I'm going to invest in these assets and long-term, it's going to come out and I'm going to do very, very well. And that should be 75% of your investing. So buying long-term rentals, buying real estate, investing in index funds, buying Bitcoin, all of that. Then 25% of your investing, you need to invest based on the economic cycle that we're in. For an example, say we're in an environment like we were just in where interest rates are skyrocketing, right? Interest rates are skyrocketing. Well, in that narrative, you need to be putting it into things that are going to do well when we know unemployment's going up, when we know, for example, gold, right? So you do a gold trade. You go ahead and you look at investing in the index funds of the NASDAQ. You put money in bonds that are paying 5 or 6%, right? And then when you watch the economic cycles change, like what we're going into now when interest rates go down, then what you do is you sell out of those assets that were doing well in that cycle. And what you do is you then rotate it in and you go heavier and, hey, you know what? When interest rates drop, what does really well? Tech stocks go crazy. Real estate goes crazy. Crypto and Bitcoin go crazy. But a short period of time. Then you roll that profit in off that 25% that you were investing and you roll it into those assets that do well in that cycle. And then when you start to notice, hey, these assets were changing economic cycles, you sell out of that and you follow those economic cycles. And then what you're doing with that is now when you're building that 25%, you just take what I always do is when I roll out of an economic cycle, and let's say I'm going to be heavy into crypto. I'll be in the market really heavy, but I'll be completely out of crypto for the short term side by April, May of next year, right? And then what I'll do is I'll take half those gains. I'll go buy a piece of real estate with it. I'll put it into my long-term bucket. I'll take the other half of my capital, and then I'll move it in when in recessionary environment starts to come back around. I'll buy utility stocks. I'll buy these things. And so
what are utility stocks?
Utility stocks would be like, so think of it this way, like electricity stocks, right? So like energy stocks, right? Things, you got to think about it. The best way to explain it this way is when
oil and gas, all that stuff.
Exactly. Or
solar.
Yeah, exactly. All that kind of stuff. And that's really where and that's the difference is most people, they focus every investment they do. They basically are like, oh, okay, well, I need to make money immediately. No, what you got to do is you got to divide your mind.
They want to get rich quick.
Exactly. And you got to be like, hey, I mean, you own a bunch of real estate. I mean, imagine if you only bought a real estate deal if it was going to go up in 6 months. Like, you know what I mean? Like, you don't think that way, right? You're like, hey, I'm looking at this on a long picture. I'm not going to be concerned if I can't raise the rent in 6 months. I know in 4 years, I'm going to be charging 20% more in rent than I'm charging now. I know that my debt's going to be paid down by my tenants. I'm going to know I've blown a bunch of the tax advantages through a cost seg out to bring down my equity on it. I mean, bring down my cost basis and my tax liability. And you know that, and over time, it proves as the winning cycle. You know, and that's where you kind of have to decide on how you're going to do it.
Yeah, absolutely. And I'll say this: the last thing about real estate, I think it is time tested, right? I'll give you an example. I think the S&P 500 came out in the 1950s. 80% of those companies today are no longer in existence. This building that we're filming this podcast in right now, this was built in the 1890s. You can see all the original brick, these arches. This building was built initially as an industrial building. They would manufacture products here and goods and supplies. They would haul it down to the ships, and the train tracks are right here. 130 years later, this thing is still bringing in cash flow. It's not industrial anymore, but it's office, right? We have our podcast studio here, office here. And so I would say real estate is time tested. It's long-term, like you alluded to. But A lot of billionaires are made in private equity.
Yep.
You know?
Yep. And I think and the way you have to look at everything, that's why I'm a big believer in a diversified portfolio. Because the one bad thing about real estate, so like for an example, let's just say stocks. I never tell somebody, hey, go buy this stock. What you do is when you buy stocks, you buy index funds, which basically means it tracks the S&P 500, right? Doesn't matter what company goes in and out of the S&P 500. You're just getting that overall proven, tested 10% returns over the course of the last 30 years, right? And the problem that most people have when they come investing in stocks, they have their financial planner that does it, who does nothing but buy low-cost index funds, and they charge them 1% to 2% per year, which erodes their compound interest. But even when you look at, for example, real estate, like the longest piece of real estate held by a single family is the King Ranch, okay? The King Ranch. It was held in the same family for 176 years, okay? And the reason why most people don't hold real estate in a very, very long term, and why I'm not the type of person that's going and I mean, probably 30% of my net worth is in real estate, so it's not that I'm against it. But the reason why I don't do everything is two big things with real estate. Number one, property taxes, right? Property taxes continuously go up over time. It's not like I buy a house for $200,000 and my tax basis here in California is going to stay at $200,000, right? And number two, you have insurance that obviously that comes with it. So there are some management costs of it, and those are kind of the downside, the upkeep. But as a long-term strategy, it will always do very, very well. And so when I look at investing, every asset has its downside that you can look at to a certain degree. And that's why I believe everybody needs to be diversified. They need to have, 3 to 5% of their portfolio in digital assets like Bitcoin and crypto. They need to have 20 to 40% in real estate, have 10 to 15% in stocks, and then have a certain amount in your own business, right? Private equity, be real. I guarantee you for almost everything you've invested in, when you've been able to start a business, the amount of money you put in to start that business versus the amount of money you generate off the business, they're some of the highest returns you can ever make.
Yeah. I mean, they say 90% of millionaires are created through real estate, but 100% of billionaires are created through private equity, which is crazy to think about. I'm curious your take on, because when I got my start in real estate investing, I cashed out a 401k, and that was the only money I had to my name. And so for me, I'm kind of like torn apart between my viewpoint of the 401k, because on one side, I cashed it out and I went all in on entrepreneurship. I went all in on real estate investing, and it paid off, right? Where at the 401k, like I invested in this thing for a long time, and yes, it goes up, but it doesn't go up as quickly as they say. But at the same token, I wouldn't have had that start in real estate, and I wouldn't have had that seed money had I not invested in the 401k. And I know this thing goes all the way back to the 1980s. If you look at the median 401k balance across by age today, 30s, 40s, 50s, all the way up to the 70s, it's not enough for these folks to retire on. So unfortunately, these folks will be depending on Social Security, and who knows if that's going to be around much longer. But what is your take on the 401k system, all the pros and cons?
So first off, I am not a big fan of investing in a 401k outside of up to your employee match. If you have a 401k, so majority of big companies out there, they have a match, right? They say, hey, we're going to match up to 2 to 3% of your income up to 17 grand. If you have an employer match and you are not putting in your 401k right now, you're an absolute idiot.
Yeah, it's free money.
It's free money.
Yeah.
So every single person that has an employer match, invest in your 401k, but only up to your employer match. Okay, that's it, because it's just free money. Then outside of that, when you roll down, every single person, if they make less than, call it $180-something thousand a year, put your money in a Roth IRA, right? Because your Roth IRA, you literally gets to grow tax-free. And in addition, when you retire, you pull the money out tax-free. And the cool part about a Roth IRA is, so you can put in $7,000 a year, right? But the cool part about that is with the Roth IRA, you can have a self-directed Roth IRA, which you can use to buy real estate, right? So the big thing is when I look at everybody and they're like, hey, Brian, what's your strategy? First thing is, number one, do your 401k up to your employer match. If you don't have an employer match, don't put it in a 401k, first off, because you're just getting the free money. Number two thing you want to go down to is Roth IRA, because you literally get to take your pre-tax money of $7,000, put it into this. It grows without ever paying taxes on it, and you get to pull it out when you retire completely tax-free. It's absolutely amazing, right? Then when you roll down from that, then what you have to look at is, okay, what should be the next asset that I could look for tax advantage? So then I would look at doing, like, if you have kids, do a 529 plan. Because
what's that?
So a 525 plan is known as a college savings plan. But here's basically the rule. You can take up to about $4,500 per kid you have, invest it pre-tax, it grows tax-free into it. And then when you go and you want to pull the money out, all of the gains you've had on it, plus the initial investment, is tax-free, and you can use it to either pay your kids. Like, I use mine to pay my kids' private schools. So my kids are, 8 and 10. They go to a private school. So I take every year $4,500 for each one of my kids, put it in there tax-free, and then I use it to pay their education. So it's an unbelievable. And if my kids, let's say your kids don't go to private school and they go to college, and let's say, they get scholarships. Well, guess what? As soon as your kid is 22 years old and they start actually earning income, you can convert that to a Roth IRA for that kid. So then you've taken all this money you've put into your kid for tuition, they get to roll it into a Roth. When they retire, now they literally can have $1 million, $1.5 million tax-free, everything else. You never paid taxes on it. It's this unbelievable tax.
And to take it a step further, if they don't want to wait to age 59 and a half to pull that money out, they could pay the penalty, 10% to the Fed, depending on where you live. State of California, 2.5%.
Yeah.
That's not really a huge tax. Pay the penalties, and then they can use that money to start a business. They can use it to buy some real estate and really start multiplying their money.
Oh, 100%. Or they can even keep it in the Roth at that point. Or even if they don't they keep it in the Roth, they could sell whatever positions they have and move it into cash and buy real estate in the Roth IRA and invest it that way. And so that's one of the really cool tax loopholes. And then once you kind of exhaust those.
A lot of our investors do that. I would say we have a fund, and I would say 20 to 25% of our investors in our fund invest through a self-directed IRA.
Yeah.
So it's a lot more common than people think.
Oh, it is brilliant. And that's what when I tell everybody this is, if you look at a portfolio and you look at the first thing you think about is, let me invest to get whatever free money I can get. So your 401k, then what do I look at? What can I get that I don't have to pay taxes on either now, or what do I not have to pay taxes on the growth over time? Because you can imagine, if something can grow and just compound without ever having to pay taxes on it, it grows exponentially more, right? And then once you've exhausted those, then really the key is what most people don't want to hear is, start living below your means. Because that is the biggest secret. And I guarantee it was with you. When I started making money, it wasn't because I got some big promotion. It's because I lived with my brother down here in San Diego at 26 years old.
What city? What part?
I lived right off Friars Road. Okay. So right at the stadium.
Mission Valley.
Yep.
Back when the Chargers were in town.
Oh, for sure. I'm still a diehard Charger fan.
Nice, nice.
And what I did is I went and I worked at a job doing mortgages, and then at night I valet parked. And I valet parked at Donovan Steakhouse.
You probably met some big players then.
Oh, it was the greatest thing ever, because I met all these guys valet parking all these nice cars. I learned from them, and then I just stopped going out, stopped partying, stopped doing
the
these
expense
things.
Creep is a real thing.
And that's what most people don't want to hear is, if you actually if you don't live like how you want to live right now, it's going to allow you to live how you want to live when you actually really care about it, living, right? And I think we all hear about it. I think you nailed it when you said, people, who knows if Social Security is going to be there, right? And here's the biggest problem that most people, when they aim for retirement, and why we know so many people that are like our grandparents or even our parents' age, that are like, dude, how are they just getting by? These were frugal people. Here's why. Most people go and they meet with their financial planner. The financial planner says, hey, when you retire, how much do you want to live off of? And they say $10,000 a month. Cool. Well, they plan their retirement. When they retire in 20 years, yeah, they get $10,000 a month. But the reality is $10,000 a month in 20 years is like living at like $3,500 a month now. They don't account for inflation. And that's the problem. So what people really have to look at doing is saying, hey, if I want to make $10,000 a month when I retire, and I'm not going to retire for 30 years, I actually need $29,000 a month. And so people don't think that way. And so what they end up looking at is, cool, I'm going to have $10,000 a month. I'm 30 years old. When I'm 65, I'm going to have $10,000 a month. That sounds reasonable. I only got to put in $9,000 in a year. Trust me, you're going to be living at the poverty level at that thing, which is why assets like real estate, or even assets like Bitcoin, or even assets in like gold and all these things,
they're the best hedge against
they're
inflation.
the best hedge against inflation.
Yes.
Because rent goes up, value goes up,
Yes.
all these things go up. And guess what? You get somebody else to pay off your debt to do it.
Yes, exactly. And I agree with you, man. They a lot of the financial advisors, they call it the 4% rule.
Yep.
Right. And so they're like, okay, the safe withdrawal rate is 4%. So if you have $1 million in your 401k or IRA at retirement, you can safely take out 4% a year, which would be $40K. By the way, that's 30 years from now with inflation, which is really gonna be worth $10K. And then you gotta pay taxes on that $40K, right? And so it's like, how are you gonna live off of that? It just doesn't it makes zero sense.
And you're going to live way longer. That's the other part we don't even talk about. Like, you look at I think it was like people that were born in 1919, I forget the exact statistic, they on average live to be 63 years old, okay? I'm 42 years old right now. I stay in good shape. I care about my health. I'm probably going to live into my mid 90s, right? So how is it possible that I can plan to work and actually start saving from 30 to 60 years old, which is only 30 years of my life, and then I have to care for myself for another 35 years of my life afterwards? And so that is why people are not understanding that the old pensions and old ways of just putting enough money in your 401k, yeah, that worked when you retired at 65 and died at 74. Like, you lived 9 years. Now, if you want to retire, you got to plan to live for 20 to 30 years after that.
Dude, it's funny you say that, man. I had a demographer on the show. This is a while back on my old podcast. I forget his name, but he wrote a really good book called Big Shifts Ahead. And he labels all the generations based on the decade they were born. And he called the 40s the savers, because they saw their parents get rocked by the Great Depression. And so their whole mindset was to save and play it safe. My parents were born in the 40s, and they've told me since day one, like, everything that I've done to get to where I'm at today, like cashing out my 401k, leaving my government job that had a pension, walking away from all that, raising private capital, buying a bunch of real estate, everything that I'm doing today, they told me not to do. They taught me from a young age to go to school, get good grades, go to college, play it safe, diversify, don't play any risks, invest in a 401k, and that's it. That's all they knew. And, back then, that was good advice because of the reason that you just mentioned. And I think, sadly, I'm fortunate because I didn't listen to my parents, right? And I think, sadly, a lot of people do listen to their parents. I have so many people come up to me at meetups, and they're like, yo, Rich, I want to get in a real estate game. I want to do this, do that. And I'm like, hey, go read this book. Go listen to this podcast. And then I see them a year later. I'm like, hey, what's up? Did you ever make any moves? And they're like, nah, my mom talked me out of it. My dad talked me out of it. My spouse talked me out of it. And I'm like, fuck, dude. Like, that's why I think today I'm like, one of my favorite sayings today is like, never listen to your parents. Unless your parents are at a place that you want to be and they inspire you, you should never listen to your parents, which is probably most people.
Oh, 100%. And my dad, my grandfather, he's still alive. He's 90 years old. Same thing. He's born in the mid 30s, and same thing. He watched the Great Depression, and he was just like, hey, you know what? I watched people I knew about people that invested in the stock market, and I watched them lose everything. So there, in their minds, stocks were high risk because they watched the crash, right? However, you look at anything else, then you look at in every new technology that comes and enters into humankind, the way it comes in is it enters into the market. The first time it gets it wrong, it goes way up, and then it's a horrible crash and a correction. Now, did the 1929 stock market crash kill stocks? Absolutely not. Did the dot-com bubble kill technology? Absolutely not. Did the crash of crypto, did it kill cryptocurrency when it crashed? Absolutely not. So when you actually look at risk, every time you are an early adopter of something, you have to expect a major crash. Real estate, right? The first time people really started making buku dollars flipping was during that 2001, 2002, up to like the 2005, 2000. That's when like flipping really started making big waves. What happened? They all got wrecked. Did real estate flipping go away or wholesaling go away? No. You just had to make it through that crash. And so when most people hear about risk and they do all these things, people remember like the horror story, and it's just an excuse to talk themselves into continuing to be lazy, and they justify it. And it's just a terrible way to live their life.
Yeah, I totally agree with you, man. So I think if you're listening to this and you're like, you got parents, you got people in your circle that are telling you not to take any risks and telling you all the reasons that it's not going to work out, you need to reinvent your circle a little bit. Get around people that are players, get around people that are actually making moves and doing it. Question for you. For someone out there listening to this right now, and they're like, hey, what's the big play going to be over the next couple of years? We're in election year. There's a lot of talk the Fed's going to start cutting rates. You think they're going to do a big rate cut here next month. If you had to pick one thing to put your money into investment-wise over the next 12 to 24 months that's going to pan out, what is it and why?
So where we're at in the cycles right now, I'll be a betting man, and I'm totally good making bold predictions. If somebody said, Brian, I got $100,000,
and this is their last $100,000,
and there's the last $100,000, and I'm going to put it in right now, and let's say I got a 12-month time horizon, tell you exactly what I'm going to do. I'm going to take that $100,000 and I'm going to go ahead and put it all into Bitcoin.
And even though it's your last $100,000,
it doesn't matter.
Damn.
And here's the simple. Now, if you were going to ask me that a year ago, I wouldn't tell you that. If you asked me a year from now, I wouldn't tell you that. And the reason why is only because of the halving in the pre-programmed cycle. And because shoot, if I'm wrong, you can have me back on the show and you can make fun of me, right? Like that's how, so I know that if somebody had $100,000 and now mind you, they could only pick one thing. It's Bitcoin right now, and you're going to exit out of the market in between February and April of this coming year. And I would be a betting man that I could take that 100 to at least 175 to 225. And then I'm selling out of it at that exact moment in time, and I'm moving that money in. And then what I'm looking at doing is I'm taking that money and I'm avoiding all of my capital gains, all of that stuff. Then I'm going ahead and I'm rotating that into a real estate asset of a down payment. I'm taking that $75,000 of pure profit that I just made. I'm going in and I'm investing into a real estate asset. I'm getting into that real estate asset. I'm cost segging it to completely wipe out all my gains on it. I still have my $100,000 in principal assets. And then what I'm looking at it from that point, I'm taking that $100,000 in that asset and I'm going ahead and I'm starting to make moves back into the AI and robotic sectors of stocks, because I'm a firm believer that how we make money today will be completely different. We have about 4 to 6 years left.
Okay, so give me an example of that. In 6 years, how will we make money?
Yeah, so case in point, ChatGPT came out a little over 2 years ago, right? ChatGPT, when it started out, had an IQ of about 70, but in every subject on planet Earth. Okay, here we are 2 years later. ChatGPT's IQ is about 110 in every subject on Earth. In about a year from now, ChatGPT's IQ will be 200, which the smartest men that have ever existed were between 160 and 170 in an IQ. So it'll be smarter than every single man that's ever existed. So we look at Amazon. Amazon over the last 3 years has cut its workforce by 200,000 human beings and put in 250,000 robots, and their production has gone up twice as much. So what you have happening now is we live in a society where efficiency is the only way that we are going to increase productivity, because we all know this generation does not work as hard as the last generation. That's a proven thing. It's 100% truth, and they have less kids. So the only way other generations were able to kind of continue to like pay off the previous generation's mistakes is they were more productive. Well, this generation is the first generation where we are a much smaller generation. Baby boomers are like 15 million people bigger than us, right? So every generation before, we're a little bit more selfish. We don't want as many kids. We get married a little bit later. We don't want to work as hard. So when you have an economy that is going more and more into debt because you have less and less people being productive in society, the only way you can fix that is by using and leveraging technology. So I believe we're only about 4 years away from having companies that there's 4 or 5 human beings and it's $1 billion company because it's being completely done by AI, robotics, and all of that. So what you got to look at, and my grandfather told me something I'll never forget. He goes, Brian, learn the mistakes from me and invest in the things your kids like, and you'll always be good. And so I look at it and I want to be diversified. I want to save money and live below my means. I want to really, before I just throw money at something, I want to do my research. I want to be a little bit cautionary, like what my grandfather taught me. But I want to invest in the things my son Slater is super into. And is my son Slater going to be more into buying gold or buying Bitcoin on his phone or investing into being into like robots and being into all these things? And if you live by that motto, it really changes your investing strategy.
Yeah. So if what you're saying holds true and AI does take over a lot of the workforce, our unemployment's going to be crazy. But then it's going to create opportunity, right? And so where's that next opportunity for all these folks that are going to be looking for work?
Yeah. So I think you have two things, right? So number one is anything that is a task, you're going to be out of a job. If you're a task person, you're out of a job. Now, what will not be out of a job is one, think of things that require interpersonal communication and relationships, right? So if you look at something like going to a doctor for a kid's checkup, that's going to be gone, right? Like that is not a skill, right? Now, going ahead and being one of the top surgeons in the world for brain surgery, probably not going to be trusting a robot to do your brain surgery quite yet. Or for an example, say you are a good public speaker, you're a good coach, you're good at mentoring people. People want that interpersonal communication. So one, you need to learn a very good skill. You need to be an expert in something, which takes time, 10 years to be an expert. Too many people want a very short road. I mean, I've been studying stocks, real estate, market, all this stuff for 22 years. I didn't roll out a coaching program at year 4 and try to teach people how to trade a bunch of stocks, right? People give up too quickly. So number one on that. Number two is learn skills of the future. So if AI is going, we all know AI is continuing to get better. It's not like people like 2 years ago were like, I don't trust this AI thing. Now people are like, dude, I'm leveraging AI all the place. So learn AI, learn how to be a consultant to help companies improve their efficiencies in the business of adopting AI. Right? Learn how to be actually adopting the technology and be a reason to help implement it rather than putting your head in the sand and being like, I'm just going to stay doing what I'm going to do until I lose my job. You're going to lose your job, bro.
Yeah.
You know?
I agree, man. I say all the time, I'm like, look, technology is never going to slow down. It's going to continue to speed up. We got AI, we got social media. And for the entrepreneurs out there that are not taking advantage of both of these, it's going to be hard to compete. Very hard to compete.
Exactly.
So,
man.
I mean, I see entrepreneurs now, I'm like, they're not taking any advantage of the AI and the social media. I'm like, you're fucking crazy to me.
Yeah. And that's what you nailed it. And I think so. My kids are 8 and 10, right? So I have a cut on my forehead because I ate shit, took my kids to this like trampoline indoor slide park. Okay. Well, these trampoline slide parks are owned and branded by these kids called the Ninja Kids. Okay. They're a massive YouTube channel with 20 million followers, okay? So in today's world, it's all about attention. Attention is the currency. That's everything, right? And so what people don't realize is most people, they want to create a community, but they're an expert of nothing. They're too afraid to put themselves out there to be wrong. And all they ever care about is trying to sell their own product rather than trying to give people continuous value, right? So if you really don't know what you want to do, learn how to master the game of getting attention, why you study to become an expert in something, and you don't have to know everything, right? Like you have AI to ask things. Yeah. You have your phone in your pocket.
Yeah.
So look at how the world has shifted. We now have YouTubers and TikTokers that make more money than the top professional athletes in the world, right? Other than, your top 10 or 20 earners. Look at Jake Paul.
Yeah, the Paul brothers are a perfect example.
And what did they do? They mastered attention.
Yes.
That's what they did. You look at these YouTube stars. They didn't even go to finish high school, most of them. They mastered attention.
Yep.
And that's what you have to learn, is if you can learn how to get attention by giving people value, then you create an annuity of attention, and anything that you want and find value in, you can already have a built-in fan base and audience to monetize.
Yep. And you will always have opportunity because of it, regardless of what sector.
Yep.
Dude, I appreciate you coming on the show, my man. I'm a big fan of everything you're doing. Where can the folks get in touch with you?
Yeah, so everyone can find me on Instagram. It's just the Brian Decker, Brian with an I, and everything is on there. You can check everything out on that.
And you got your new program that's rolling out soon. Tell me a little bit more about that.
Yeah. So Wealth Society. So this was something you could probably tell by I'm passionate about a lot of different things. And, my big thing is I went through Dave Ramsey's thing when I was younger, getting out of debt. And I love a lot of his theories, but nobody yet has really created something in the modern day world, incorporating things like real estate and digital assets. And so I spent 22 years turning my life around and mapped out the whole journey. And I spent 2.5 years creating the most complete course on every single thing in community. And I want to make it so every single person can do it. So it launches actually on Alex Hormozi's platform School the first week of September. People gate stuff too much. And for me, I've been fortunate enough to make money in my real jobs. And so for me, this is what I want to do. It's like you do with this. You don't get paid to do this podcast. It's not like you're, a news anchor. You do this because you have somebody helped you along the way and you want to repay that through the law of reciprocity. This is your vehicle to do that. So this is my vehicle to do that. And I'll make money on my own stuff outside of that. I don't need to charge $1,000 a month to learn all this stuff. That's just going to keep all the people that really need it out of it.
Dude, appreciate you so much, man. I'm a huge fan of everything you're doing. Keep crushing, keep inspiring. Next time I'm out in Scottsdale, let's definitely link up. Maybe we'll run into the pod, definitely have you out for a meetup. But yeah, man, he's Brian Decker. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Let's go. Peace.